All right, Roku, definitely an interesting earnings report. It's one I was definitely waiting for here. And you see, as a result, the stock's down 10% after hours after this earnings report. So we're going to take a little deep dive, see what's going on with it. It was up 8% in the normal trading session, so let's be fair. Overall, 10% hit it's pretty bad after hours for sure. Down to 123.88 after hours right now. Definitely some crazy stuff, but we'll take a look at these earnings and see what might have caused it. So, Roku with a GAAP EPS of negative 45 cents, which is in line with expectations. Again, this company's not profitable. It's one of my main reservations about investing in the stock at the levels that it's at right now, just because of the lack of profitability. And revenue, though, from this perspective, 321 million, up 55% year over year. Pretty massive there, beat by 11 million. It's a very big beat in terms of revenue for sure. And all things considered, this is a very beneficial environment for them. So they have a big opportunity ahead of them. As we see now an even bigger rise in streaming, Roku can be a big player in that. And I think that's where you see this revenue hit, or this revenue boost. And we'll see it again next quarter, probably by even a little bit further. So Roku had a 2.9 incremental active accounts in quarter one to reach 39.8 million. Good stuff. So Roku is down, really just because cost rising for the most part. But revenue rose 55%. Gross profit jumped 40% to 141 million, but operating expenses rose 76% in the meantime. Expenses rose big. That's a scary thing, all things considered, because we talk about, honestly, how things go in the future here. Next quarter, if it was hit harder, obviously this next quarter is going to be hit harder in terms of our current situation. Operating expenses already rose 76 prior to that. Gosh, it could be rough. So they had an operating loss of 55.2 million. From a year ago, operating loss of 10.7 million. So they increased their loss quite a decent bit, around 5 times, over 5 times as much. Pretty crazy. Net loss widened to 54.6 million versus 9.7 a year ago. Hate to see that. But along with gains in active accounts, streaming hours rose 49%. Not a shocker at all. And average revenue per user rose 28%. Not a shocker at all. From revenue breakdown, you see platform. Which platform is going to be the Roku streaming platform? Just the, kind of like the operating system there. And that made up 232 million of that, up 73%. And player is going to be like your Roku stick, Roku Express stick, or whatever things they have, Roku boxes. I can't remember. I think it's just sticks. They have the Express stick and one other one. It's just the basic one. I forget exactly which one or what they call it, but that's what you're going to be talking about on the players. Up 21.7%. Pretty exciting. Gross profit breakdown. Platform was up 39.3, and player profit was up 47.6. So let's take a look at that shareholder letter. And let's see some of these highlights. Again, they'll mention platform revenue, pretty massive there. Streaming hours, average revenue per user. Pretty excited. It's kind of all that we went through, but overall you can see a chart here. A couple different charts in terms of how they've grown over the time. So active accounts, if we're talking about last year, they only had 29.1 million versus this year during this quarter, a 37% change year over year to 398 million. Pretty massive growth there. And streaming hours rose 49% year over year as well. Pretty big. Definitely something you like to see. And as that average revenue per user increases, they really should be banking profit like no one's business. But somehow they're failing it. It's just not good to see in that aspect. You'd like to see a little better from them. Total net revenue, we see from platforms up 73% year over year. Massive stuff. We're talking about 134 million versus 232 million this year. It's just big growth. But where you see concerns here, would be the expenses increasing. R&D, research and development, up 58% year over year. Sales and marketing up 102% year over year, and G&A, so your general expenses, up 80% year over year. That is ugly stuff. That's massive change there, and obviously a big portion that's going to be sales and marketing, taking up a huge chunk of that. But research and development up big too. Just crazy to see that stuff year over year change. It's just ugly. This is a company that actually brought home some adjusted EBITDA previously to this year, or to this quarter, I should say. In this quarter, pretty bad numbers. Definitely pretty bad numbers. Down 264% year over year. But again, it's not necessarily fair to say that. But so, yeah, very interesting stuff. Account acquisition following a strong Q4 2019 holiday performance. Sales in both the Roku players and Roku TV models remained very healthy year to date, and I think you'll see that grow also. People are buying a lot more televisions right now because they're staying home. A lot of people are just upgrading what they have at home. I've been selling so many TVs at work, it is crazy. You wouldn't even imagine it. But despite, accounts for more than what was I at there? Despite some supply chain disruptions, we saw factory closures after Chinese New Year, but since then factories have gradually ramped up production. In quarter 1 2020, player units continued to be robust, up 25% year over year. Roku TV models produced and sold with TV OEM partners account for more than 1 in 3 smart TVs sold in the U.S. and more than 1 in 4 smart TVs sold in Canada. So by that, they're really talking about, I think, I don't want to misspeak. I know TCL and Hitachi certainly do. I don't want to say Philips does or not, but maybe. They have like 10 different TV brands that they're partnered with that come based with Roku in them. So that's a big portion of it. They're saying those TVs counted for 1/4 of the sales. Again, the majority of the other ones are going to Vizio, Samsung, and LG. So pretty exciting stuff there, all things considered. While they are hoping for a speedy end to the pandemic, it is likely that its effects will be with us for some time. Much uncertainty remains, but few things are increasingly clear to us. Streaming and the ease and value it provides is more relevant to consumers than ever. So they're expecting ad rates to fall in the U.S. in 2020, but they expect to grow substantially year over year. So that is going to hurt overall, is what they're saying. It'll hurt them just a little bit. Definitely interesting to see. Finally, we'll look at the balance sheet on this company and see what they have going on. Cash and cash equivalents went up around $70 million quarter over quarter, $588 million. Total assets in general in this company of $1.5 billion. Not bad, if you ask me. But then we also see total liabilities on this company of $865 million, rose from $771 million year over year, or last quarter, I should say. So that's a very big increase in terms of that debt load there. And a majority of it's kind of spread out, but accounts payable went up quite a decent bit. Your total long-term debt went up pretty massively, right around $70 million more in long-term debt now because they've raised some capital. But overall, you see a total stockholder equity of $675 million, which is overall, it's a decent balance sheet, but the concern there is going to be with those increasing expenses. Is this a one-time thing, or is this going to be a steady thing? Because if it's a steady thing, well, we don't want the company losing $50 million each quarter. It's just, it's not a beneficial thing. So how's that going to look in the future? It's what I'm interested in. And it's kind of hard with these companies just pulling guidance. It's hard to actually know what's going on. I don't know what to think, but at these levels, I don't personally like Roku as far as the stock to pick up. And we're talking about a company that is, in fact, still down year to date, to be fair. After this after-hour trading, it's down overall. At one point, it dropped down into the 60s, 52-week low. 58 on this company, which was back way back when in last year. So I just don't like it at these levels. I like it more at the levels of $70, $60, just because the lack of profitability is, I don't know where you're valuing those shares in the short term. Now, long term, I could see you doing that, right? I could see you certainly doing that. Company trading at $16 billion market cap for a company that's bringing in $1 billion in revenue in the year is a little steep, but I could see you trading for that growth if you're just anticipating massive growth continuously. But if those expenses keep increasing, it's not going to look good. So I'm going to stay out of this company for now. I wish I'd gotten in it, obviously, whenever we saw this dip here. We're talking about since their dip. It's a company that's up, has doubled really since their dip. But that's why I don't think it's time to get into this stock. It could hit a wall coming up, but I'm not going to get involved with it, unfortunately. But if you're interested, I completely get it. It's a very interesting company. I think they're going to do super well in the future.